Welcome everyone to the Kendall Report. It is Sunday night and getting ready for a big week, Fed week coming up. We've been waiting for this for a while and talking about it for a while. I've been saying since the last meeting that they're going to raise again this time. A fair amount to talk about tonight, and I just a bit of an alert. It's possible I do have to be out of town early in the morning, but I should be back in time for the broadcast tomorrow. So the worst thing that happens is maybe a half hour late start. I don't think that's even going to happen. Just putting it out there just to hedge up just a little bit. So let's take and talk a little bit about Friday. Pretty ugly day, right? Lots of selling, quadruple witching day, lots going on with the expirations. And I think there was some rhetoric flowing around the markets really about this whole auto strike situation. And I ended up naming this video Deciphering the Fed's Next Move, but I wanted to put it, is the EV market actually destroying America and the economy? I'll probably touch on that theme. I think it's interesting because what we're seeing with the auto workers, that they're realizing that the paintings on the wall, so to speak, is that there's a lot of jobs going to disappear, not to mention that their employers are losing their you-know-what on trying to be in the EV market. No one's making any money in this thing other than Tesla, right? So, Tesla's 100% automated, or 100%, very close as you can get to it anyway. A lot of robots around, and it doesn't take as many people to build these things. And meanwhile, the UAW thinks that it's time to increase your wages by 40% while they're trying to convert to EVs, losing money, spending billions of dollars to build cars that are actually never going to replace gasoline cars, maybe hydrogen, maybe something else, but not electric. There's not enough lithium on the planet that can be extracted and turned into batteries fast enough. Need some new technologies, and that could happen. They could come up with something tomorrow, and they don't need lithium, and maybe there's a way to produce, everybody's got their own nuclear reactor in the backyard. Until something like that happens, there's a lot of challenges ahead with the whole EV thing. But it's just interesting what's going on. I guess I stumbled into this. I'll go back to the Fed in a minute. But I really feel like that the scenario that we're looking at here with the unions and all of that, I put a tweet out, I think it was yesterday. I was just thinking about this stuff, and I put a tweet out talking about really what could happen is we've already seen FedEx and UPS and now the UAW. And I think there's about 50 million people in the U.S. anyway. Europe's a little more unionized than we are here. But this is just like everybody's going to want to raise. And if this gets any kind of contagion, this could really disrupt a whole lot of things. And I think it's already here, actually, from that standpoint. But the sad part is that the Brandon and the boys and girls in Washington, D.C. are kind of behind this. They're pushing it, and they're giving them validation. That's the UAW, and the companies are kind of shaking in their boots right now. I don't remember her exact name, but the CEO of GM, I guess, makes $34 million a year. And I saw something. I'm looking for this quote that I found, and I'm just looking for it here right now. But it's basically they're standing up to these greedy corporate profits, and those are all going to go away very quickly if they go too deep into this EV syndrome that I'm just talking about. So. Yeah, it's interesting tactic, interesting time from that standpoint. Listen, I grew up, my dad was a carpenter and a union guy. I was in the unions. I was in the steel union. And I mentioned a story about the steel workers that was kind of perpetrated on the steel industry back in the 80s, and it changed everything. And I don't know where this is going, and I'm not necessarily pushing back against it, that people don't deserve more money. That's not what I'm saying here. It just seems interesting that what's going on is like, because of inflation, because of these terrible policies that are driving everything right now, it's making folks to want want higher wages. Who doesn't? I mean, there's a high-end store I went to. They wanted the other day I was there, $34 a pound for prime beef, right? So I know with the big box grocery stores that's not the case, but it's just crazy what's going out there. And the inflation, who doesn't want more money? And who knows that in my scenario, I'm trying to get out of this loop here. The scenario is that if we go too far down this trail, then we haven't seen anything with inflation. And that's going to be the really big story, because now we're getting the wage inflation, and then there may not be the pricing power. It just kind of all implodes at one stage. So that's actually good. It leads me right into the Fed. Okay. What I've been telling you for a while is that the Fed is definitely going to be raising rates this week. I don't see how they get around it. They have to stick with this inflation story, and there's no reason for them not to. If you look at claims, continuing claims, look at CPI, PPI, everything that came out last week, it's all there right in front of you. So if they don't raise it, I'm not sure what the reaction to the markets would do. I think they will raise it. I've talked about this as well. I think most of the impact of a raise is already built into the markets. You could go back on this channel, listen to videos that I did on the Fed, maybe look for headlines or titles on these videos about the Fed, and you probably go back and you'll hear me talking about my terminal rate was 5.5%. Well, that's where we're going to end up this week. 5.5 to 7.75 is my opinion. And you can see how the treasuries are trading, everything that's going on. We'll go into detail here just in a little bit, but everything's lining up just for this scenario here. And I just happened to look over the timeline, and somebody was talking about energy is about to explode. And I've been talking about the energy prices moving up. Everything's going the wrong way. The Fed sees this. I'll go on to this rant just a little bit more. The Fed's not looking at the retail reports that you and I look at. They've got lots of other metrics, and there's surveys, and they're calling on the phone, talking to people, and there's a whole lot of stuff going on that they know that things aren't really getting better. The disinflation is a common word used around the markets, and that's just not really a real thing. Okay, it's not really happening. I don't see it. The gas pump prices going up. I was at the store the other day. Didn't look like things got much cheaper there. Like I said, it's just a real. It's not happening, folks. This thing is still really tight, and now that we're getting wage inflation potential, depending on how far this thing goes and how far the unions are likely to take it, and how one of the things I said in this tweet is that I don't think we have the leadership in the companies. We've got a lot of, we'll just say, wokeism around. I'll say the quiet part out loud, that it's going to be very difficult for some of these companies to not fold their cards and give in to the labor unions and labor in general. And like I said, I'm not arguing that folks don't deserve more. It's just the idea that people get emboldened by these things, and boy, it just gets out of control. Now, I haven't seen any, probably since the 80s, any real strikes. And I've seen some of the impacts of this, And I know the unions claim to be out for the workers. In some ways they are, but sometimes they get really, really misled by these people. And it can be really devastating. We'll see how this all works out. Continuing story, to say the least. Just looking at my notes here. Circle back to, just for a minute, back to the Fed. And I think we're going to continue to hear certain things on Wednesday's meeting. I still don't know if I'm going to be able to do a live session that day. I will come on probably on Twitter or Tuesday. I probably won't be able to let you know until Tuesday night, the night before Wednesday, whether we're going to do a live. I'd love to do a live and be able to show you some of the indicators working. There's some crazy stuff that I've been working with that I really want to show to you folks. A lot of you already have the indicators and all that. So if you don't have them and you bought the first round, there's still a customer appreciation discount, I think, for another 45 days. So don't miss it. It's really, really pretty substantial. So make sure you do that. So you go to kendallreport.com/indicators. But yeah, so let's just focus for a minute on what I think the impacts of this week is going to look like. I'm just going to some of the, we'll go through the economic releases that are coming out this week. And some of the things that I think are continuing, you're starting to hear more noise about the housing market again. You got a bunch of these characters. There are millions and millions of videos on YouTube for the last year and a half, how the real estate market's going to crash, and there's just thousands and thousands of homes on for sale. No one's buying anything. Total BS. Market definitely isn't what it was, after the pandemic, for sure. But there's still quite a bit going on out there. Let's talk Tuesday. We get housing starts come out 1.43. Permits come out at 1.435 is expected. That's 1,435,000. So they're building. That's a lot of houses. Listen, we've underproduced in housing for probably 10 years. I don't even know how many units we're short. We're short probably 5 to 10 million homes. I don't even know. So that's just a guesstimate number. But we are short a lot of inventory to house people. Wednesday, we get mortgage apps. That was down last month. Not a big deal. But really, Wednesday is all about the Fed. I've already talked about what my expectations are there. Quarter point increase. On Thursday, we get claims. We get continuing claims, 230K on the claims, and then on the continuing, it's at 1.688 million. And the only number that matters to me, and I haven't even said this number for a while, would be if we ticked up over 2 million again. And that's not likely. It's been hovering between about 175, maybe down to where we are now, 167, something like that. So it's really not been fluctuating a lot from that standpoint. And then we have the Philly Fed index coming out. That's expected to be minus 4%. And then we have LEI, leading economic indicators. People used to care about that. Really not watched very heavily, but minus 0.05. And then we have on Friday, we get a couple S&P PMIs coming out. Manufacturing, negative 47. I forgot to write down the services. They're not big reports that anybody watches, but that's really the week ahead of us. So everything's going to be focused on the setup that we're going to get on housing, and then we come right into the Fed meeting and the conference call. And like I said, I'll let you know if I can do something live there. I've got a lot of notes here that I just want to look at here real quick. I have 2 pages tonight, so I just want to make sure I've covered everything. And it looks like I probably have hit on everything. Just real quick, last week, as ugly as Friday was, we managed to close flat on the week. S&P down 0.02, It's up 15.9 on the year. Nasdaq at 0.04. It's up 31%. Russell down 0.02, now at 4.9% on that. And I believe we had 8 of 11 sectors were positive last week. So overall, there was a lot of rotation going on. I'm going to go through the WaveTech database here in a minute. You'll see that's even what we're seeing in the database. Nothing material is changing from what we've already been seeing when it comes to database. So looks like to me, it looks like to me that will pretty much settle this week from the standpoint of the more rotation going on. So let's go ahead and get into the database, the rest of the broadcast tonight, and should go fairly fast, I believe. All right, let's get into the WaveTech database. So here's the weekly database. It's now and the intermediate is at 61.16%. We had 246 buys, 274 sells. So basically it's just staying right here, a little bit of a rotation going on. Nothing really material at all. And this is what I was referencing just a minute ago. And this is really solid. As we go forward, we're likely to see this just continue to rotate. I've been telling you the numbers to watch. I don't expect we'll get much under like 58%. We should stay under that number. And then 52 would be an extreme. I think if we did see some liquidation, we won't find out anything about that till we get into the end of next week. So let's take a look at the daily database here. And we're at 33%. We got down to about 27 or so. We get a little bit of stabilization here. Same kind of thing going on even on the short term here, is that we got 274 buys versus 357 sells. A few more sells even after that big down day. There was not a real big tranche of selling coming in. And so we're really just seeing the rotation going here. So what it tells me is that we're really at this place where we're going to see the market just continue the churn here. And it makes sense. I've been setting this up for this third week of September. So this is kind of what we're coming into right now. It'll be the 18th tomorrow. So we're right there at that place where we're seeing a lot of the algos signaling potential change in directions and things of that sort. Let's go ahead and get into the technicals for tonight. All right, so we'll start with the hourly S&P. And what I'm seeing here is really this thing is bottoming. Looks like we're going to turn. We're up 5 handles right now, a little bit more. And looks like we're going to start to challenge at least a 10-hour moving average and move up into around the London Open. And then it looks stable as we go through the night. So I suspect we'll move back up a little bit we're on the December contract now, so we're looking at 45.05. We printed up into that all the way to 45.66. So this was a pretty good move back to 4,500. And there is we're probably going to see, as we go through the different phases of this week, we'll probably see a rally back in to some of these midpoint on this. We'll look at the weekly market grid. We'll look at the daily market grid for tomorrow. Yeah, so I see Mr. Stone is telling us what's going to happen. Yeah, Fed's not going to be lowering rates for a while. So anyway, the patterns that are out here are fairly significant. Let's go in and take a look at go to the daily so we can get a handle. We did get an STX buy signal, so we're at least going to get that sideways. We've already started the evening off with a little bit of a bid, nothing substantial. Let's take a look at the market grid here. Really what we're looking at here is the S1 is, get to the right number, 4486, R1 4509, R2 23. So I would look for, I don't think we get down to the 86 number, but it's possible. That would put us down to the 21 period moving average is the lowest moving average in this pattern right now. That is at 4477. So that would be your extreme, which would put us down at S2. So we may see volatility, market grid turn down after the STX buy. So what we'll probably see is at least an attempt to get back above the moving averages, which suggests, and it's not even that big of a deal, get back around 4506, something like that, is not even a big deal. That would just put us up here around R1. I suspect S1, R2 for tomorrow. So let's take a look at the weekly patterns. Oh, before I move on, the PPMs are still slightly positive here on PPM 1 and 2. PPM 3 is flat to down. So we're just looking at a stable pattern. If you recall, prior to Friday action, there was a little bit of a bias to the upside, and that all reversed from that standpoint. So it looks like more sideways. And if you go back in real terms, if you go all the way back to the end of August, we've just been chopping around in this sideways pattern. There hasn't been any real trend up or down. And it does look like there's still a slight bias. Let's go to the weekly because that'll give us a little better view here of what to expect. And weekly was originally, if you go back last week, and these algos update as we get real new market values in here. But we're looking at right now the 10 period moving average 44.98. The 21 is all the way down at 44.10. That would be an extreme this week. And also, if we look at the market grid for a weekly, that would be really S3. So if we go S1 44.74, that would put us down into the 21, and then the possibility of R2 45.48. We're probably going to see some extra volatility depending on what happens here. And if the Fed, we'll put this out here and we'll talk more about this when we get into the interest rates. But if the Fed didn't raise rates, that could send a really negative signal to the markets. Maybe that would end up to be more bearish than bullish. And but for right now, it looks to me that everything is pointing to the upside. And like I said, even if they raise them this week, it's all priced in. I mean, if you split the interest rate markets or the bond traders are about 50-50. 50% expect an increase, 50 don't. And in the end, everything's priced in. And I don't think that it's going to have that much of a material effect. But having said that, and I'll go into this in more detail, the expectations will be more around what Powell says than anything else. All right, so you can see that we still have a slight upslope as we come into, I've talked about this, we are right at the point where we're potentially going to see some turnaround here, but we still have, I think, another week or two. We could ride this slight wave to the upside into the end of September now. And I said when we got here, we'll be able to see a much better viewpoint. All right, Mr. Stone, make a bet with you, brother. M. Stone, I'm assuming you're a brother. So, yeah. Anyway, the point is that what we're seeing here is still some upside here. Like I just said, it doesn't matter if they do or they don't raise the rates. It's really baked in, the whole thing. But the issue that I'm seeing here with these algos is that we have a slightly negative 10. We've got a positive 21. The 21 is up 0.34. Anything over 0.25 is a trend. And what we're looking at here then is that's way down at 44.10. So that would be the extreme on the downside, and it would map out fairly good with an S3 type move. That would be really deep. Like I said, my expectation would be S1, R2 on a weekly, the potential of an S2, which would put us down right back to that 44, 47, 44.60 level would be a key level from that standpoint. I like it. You guys are confirming that they're going to raise rates this week. I appreciate it. So let's go ahead and move on to the Nasdaq. Second here, got a little glitch going. So looking at the Nasdaq, we'll start with weekly. We'll go top down. Weekly is still really projecting more of a sideways range. There's some fib targets in this pattern that suggest down to the 21.14.958. There'd probably be a potential a little follow through from Friday's sell-off, and looking at a little bit of a pattern that looks like a sideways pattern that's likely to unfold. And I did forget to mention, folks, and go back and look at it, we did have an outside reversal on the S&P on Friday. So there could be a 3-day trade here. So just reference that. I'll take a look at the close tomorrow. We'll talk about that at that point. So there is some potential downside that could force us down in on the S&P down into that mid 44 handle. And here on the Nasdaq on a weekly, just looking at the market grid here, S1 is 15,275, and then S2 is 15,145. On the upside, R1 15,508, 15,638. So that would probably be where we should stay within. I don't see us getting above last week's high. I think we end up with maybe challenging the weekly low, which we're basically trading at right now. So let's take a look at the daily. So daily has trading right down into the support levels. This 21 period moving average up 0.19 on PPM2, still above its first second derivative. Meanwhile, you got a downward slope 10. So there's definitely some resistance, but we did get the STX buy here on the Nasdaq. So that suggests 1 to 2 days sideways. We probably stay within those bounds between the 21 and the 10, which right now that puts us at the upper end at 15,490 on the downside, 15,318. But I would go more with the market grid numbers I just mentioned. All right, going to Russell. Pretty good hit on Russell. This is the daily. Russell, this is the cash. And so we're looking at some potential for this thing to stabilize. Like I said, we actually got STX buy signals across the board on all of these indexes. All that means sideways to up in the next couple sessions, and it should be limited. If you look at the market grid numbers, should be an R1, R2 number is typically where we'll go after an STX buy. You can see some improvement as we go through the week. By the time we get to Wednesday, the Nasdaq's at least forecasting that we're going to maybe Nasdaq. The Russell is forecasting that we're going to get a little bit above, potentially back into these moving averages, maybe back toward the 1860, something like that. So it looks fairly quiet. Let's take a quick look at the weekly. Weekly's fairly ugly from that standpoint. Looks like more downside here in the Russell. And, I've talked a lot about the lag in the Russell. We just can't seem to get any traction. There's awful lot of small cap companies that have lots of refinancing, lots of issues in that area. And this pattern is set up is really fairly negative here as we look forward. And this is the cash index, not the futures. So it just looks like a number of patterns that are breaking down here. But in real terms, and I hate to say it again, really, if we go all the way back to June of last year, this is just a sideways chop. It's just a monster consolidation. And if we went out, I'm going to flip out all the way to a monthly chart here. And I think this is probably worth looking at. You can see we've just been consolidating here, and there's really no trend here at all other than sideways. So once you get up at the upper end of these ranges, it just kind of moves back in. We just can't get out of the way. And that's a similar scenario like with gold and other there's a lot of commodities that are kind of locked in these patterns as well. So here we go with the 10-year treasuries, and they continue to print up. This is the weekly chart. And you can see the algos are suggesting that we really are going to stay higher, potentially all the way into year end, and most likely maybe even into the first quarter of next year. This is the weekly 10-year. Let me go over to the daily. I'm sorry, that's monthly we're looking at. I forgot I had it on that chart. Here's weekly. So weekly is still got some upward bias. Let me change the scale so we can see a little better. You still have some upward bias into mid-October here. So there's still some upside. And there's no reason to believe that the Fed's just going this higher for longer thing, cliche that everybody throws out there. And as you know, I've been saying that we're going to see higher yields for many, many years to come. Those of us that grew up in the late 70s in this market, I started in 1979, and we got up to 25% basically. They're not where we are right now is where rates belong in this, we'll call it 4 to 7% range, maybe 8% on the upside, especially when it comes to mortgages. That's where yields belong from a standpoint of risk and returns, and all of this stuff that is being presented and how yields are going to go back down, and the only way the economy works is lower yields is completely incorrect. And in fact, if that were true, I know they're going to say, well, the higher yields haven't clicked in yet. Well, they have. Go try to get a mortgage, and you're going to see while mortgage apps are down, they're not non-existent. Otherwise, there is still activity. There's been a fair amount of activity, even though there's been buy downs by builders and other things that have been out in the mortgage market to continue to keep things going. But that's how the economy's always worked. Is there's going to be incentives and to keep things going. One of the things that I heard I hadn't even heard about this until I think it was about in the last 2 weeks, is that these builders, interesting enough, have continued to build, and they're basically renting these houses out. So that's why you see brand new houses for sale, but it's sort of like financing. It's when the automakers many, many years ago started to finance their inventory. So you could get loans at GMAC and all those. Same kind of thing going on now. It's like by renting a house from one of these big builders, they're basically financing their inventory that they can off later in the cycle. So a lot of this stuff is going on, which we had back in the day in 1979. Back in those days when there was something called creative financing, which was basically owner carryback. So there was lots of ways to keep the housing market going. And in 2008, when we got to that mode, in that crisis, back in the late 70s and 80s, most of the mortgages were assumable. And in 2008, none of them were assumable. You had to write new paper. That's why the disaster was so big. You had to go out and recreate new debt, and nobody was doing that at the time. So now we're at a different place where things are going more toward some of the owner financing. There's a lot of creative stuff going on out there, and it's kind of interesting what happens. I have a couple good friends in the real estate market, and while it's not what it used to be, it's different in the way things are getting done, but there's still transactions going on. Yeah, and it just depends on the institution too. I see somebody talking about somebody getting turned down with the 821. There's a lot of other considerations on some of those, especially the institution itself. Some institutions want to see deposits as well. You can have a good credit score, but you don't have money in the bank. There are definitely tighter standards out there right now, for sure. So, but there's still activity. We're going to see 1.4 million new starts out there. So, like I said, they're not out of business. Business is slowing, but it's not going on. But anyway, these rates, you can see it just still forecasting up here on the 10-year for a while. We still have this angle of attack going up into October, and then it's just flattening out, and it's flattening out around this 430 level. So there's just not, if anything, we probably stabilize as we come into year end. You can see the forecasts. These are kind of bogus, I will say, when we go out to these, where my cursor is way out here, looking at back over in June of 24, is showing that rates are going to start to decline. Maybe that's the case. Maybe the algos have it 100% right. But for the most part, what we're seeing here for at least the nearest given future that we're in, we're going to see rates stay stable up here from that standpoint. Yeah, it's interesting. Somebody keeps talking about Airbnb being a short. Airbnb, actually, my brother owns a fair amount of these things. and they make their money when people rent. They don't own houses, right? So the rentals are always around 35% occupancy. I did some research on Airbnb, and if I put Airbnb stock up here, it's doing really, really well. And that's why, because they're just collecting fees off rents. And if you look at the vacancy rates on those things, they're always huge. So it's kind of interesting. More research would need to be done. I'm not claiming to be an expert on that, but that's not going to have any effect on the real estate market. Like, that's another one of the scenarios that Airbnb properties are going to roll everything over, and so that's not the case, I don't believe. And just real quick, while we're on this subject, the commercials are propped up by the lenders. And by the way, all the big commercial properties, these guys all love each other, and they just trade properties, and the lenders will extend and pretend. So no one has to really take the hits. That's another fallacy that I believe is in the market. I'm an ex-commercial real estate guy many, many years ago. And that is one of the things that I've seen is these guys they'll just extend the loans. No one has to take the hit. I mean, what are you going to do? You're going to call in, BlackRock and some of these big players out there? No, they just extend the loans. They'll rewrite the paper. It's kind of a joke. These guys have deep pockets. Some of them, there's been some defaults. Don't get me wrong, but it's not the catastrophic scenario that everybody wants you to believe. And it's pretty obvious, I think, as we go on. But I think that, I wouldn't argue with not owning lender stocks. Although, if you folks would have listened to me in January, you could have made like 100% on your money just owning the builders. I told you the home builders were the place to be. And that was, they backed off now, but there was over 100% gain. Those of you that have WaveTech, you can see some of these trades in there. They were huge trades. And I was screaming about that last December, January. And these are where a lot of big moves are being made in those stocks that seem like very counterintuitive. And it was reason why I was yelling about that is because of what I was seeing in a bunch of these subsectors and these industry group indexes in WaveTech and those type of things. So there was a huge play there. That was like really easy. You could have just moderately put in on the home builders and made some serious bucks, 40, 60%. You could outperform the Nasdaq very, very easily. And, the whole idea that the Magnificent Seven, all that, we cover 15,500 stocks, rough numbers. And, even right now, we're looking at, 10,000 stocks in trend mode. So there's a lot out there that we're to be able to play. So I don't want to go too far down this trail, but these rates are still going to be moving higher for a little bit here, and there's not going to be any reprieve, at least not at the moment. Now, having said all that, kind of getting into a rant of some phase here. I just want to. I'm going to put something out here real quick here. I'm coming back up on screen for just a minute because one of the things that we have to watch, and you can have forecasts, look at these charts all day long, but one of the things that we have to watch for here is if there is any material. Some of the things I started off with this show tonight, whether we start to see material issues happening with wage inflation and other things that could roll everything and blow up the best of ideas. So as always, though, I'm always using my WaveTech database from understanding what kind of rotation, how many companies are participating in the trends and all of those things, because if you don't, that's what always has saved me, folks. I've been doing this for a long time. the WaveTech database has been around for 25 years. So this has been decades. And I know there's people that watch this broadcast every day that have been around me for the bulk of many of those years, have been institutional clients of mine, and know that how we've rotated through all of the good and the bad over the years. And there's some cycles that are more difficult than others that have not the traction that we get. But right now we're still at 61% of the stocks are trending. This is not the kind of configuration that the market's going to roll over. But I'm doing a but here, air quotes, is what can happen if some of these economic situations start to grow. I don't think they will. Most likely, this auto thing will last maybe a week or less. I already saw a few stories that there's some good talks going on with Ford already. So, like I was trying to allude in the opening comments, is most of these guys are just going to fold the cards and try to come up with some deal just to go forward. And maybe that doesn't emerge since the, what is it? It's 4 for 40 is what they're going for. 4 years, they want a 40% increase. And it's just a matter of any of these narratives start to get traction and we start to see effects in the economy. And those will start to show up in a lot of these stocks, and we'll have a warning. I've told you folks before, and I'm kind of back on the WaveTech database, but I've told you before, and many of you met me because I started to get public on YouTube back in, I guess it was February of 2020. We were already in heavy cash coming into the pandemic. And then in March 23rd to be exact, well, we got monster buy signals coming out of the short-term models. And by July and August, we were getting big-time buys on the intermediates. And so the whole market rally was revealing itself. So the opposite happened, when going back to '08, going through these situations. I've been through lots of cycles. And when you're looking at 15,000 and looking at this mass database, it gives you a much different concept. And it's what kept me bullish all year. Okay. That's why I was forecasting 46, the 46 handle on the S&P because of that. Now things are still pretty robust, as I said. So I guess what I'm trying to say is we need to watch out for any shifts that happen. Nothing's forever, right? So if we start to see these shifts happen, then maybe we can start to get concerned. But one of the best inflation hedges in the world is the stock market. So for instance, if you look at the 1980s when rates were, we had 25% inflation. If you look at 1980 all the way through the '87 crash, there was monster double-digit inflation, and the markets did really, really well. So just know you kind of have these metrics are really confusing, and but I just kind of wanted to come back on screen and talk about that for a minute, because these things can shift, and you've been around. If this thing shifts, I'll be the most negative guy on the planet. I'll flop this thing in a heartbeat. That will all happen through data, through evidence that is happening. Right now, there's no evidence of any of that stuff. So thanks a lot. Let's go ahead and get into the, let's go to crude oil. So here we go to crude. This is the weekly chart that I have up here. This is showing lots of higher prices all the way into year end. This angle of attack on a weekly is pretty substantial. The only thing, and this is what I've been talking about, this is the week where we start to see some of the upward momentum start to falter a little bit, and we still could see a switch, but it looks like everything wants to flow at least into late October, maybe beyond. And, the SPR has been completely blown out. So we have no reserve. And now we're buying oil from Venezuela instead of turning on our oil patch. And so everything, and with the Saudis and basically OPEC in real terms, is continuing to keep production cut back, and they're going to squeeze Joe Brandon as hard as they can. I don't think they like this guy. So the point is that these trends are very intact here. So if we look here and we go to daily, you can see even the daily trend here is showing. Let me change this scaling a little bit. We still have right into the end of September, early October, and then there's another ramp up is expected coming down the road. The PPMs are starting to roll over a bit, but we don't see that happening until probably next week, and all that tells us it will challenge these moving averages. So right now the 10-period moving average is 88.40, and we're just continuing to move this up. I'm going to go back to the weekly. I want to look at the weekly market grid real quick. Last week we got up almost, I think it was R3, 91.06. The high was 91.23, so we printed just above there. This week as we come in, we're looking at 91.89 is R1. That would be a new high for this move. R2 is 93.15. And on the downside, S1 is 89.65. So I would look for that to be in play. And there's a pivot number here. It's kind of hard to see. It's right here at, let me give you the exact number. It's 85.28. That is basically your pivot to the downside, which is very close to the 10. This is a weekly 10-week moving average here. So everything looks upward sloping, and crude doesn't look like anything's going to change anytime soon. And that also is another indication probably there's not a lot of economic impact. So I suspect this whole auto situation and any concern around, I just wanted to talk about that because you do have to pay attention to what's going on the macro side of things. But it looks like from a technical and a quant viewpoint, everything looks fine from our database to this upward sloping patterns and weekly charts and all of that. It just looks like everything's kind of going up together. The indexes on the equities, as well as interest rates, as well as commodities like crude oil. All right, folks, we should be able to get out of here pretty quick here. At gold and Bitcoin, then we'll be done. So this is the weekly gold. It's interesting. We now have upward and down fib targets. On the upside, this is weekly. We got brand new fib targets here, pushing up here at 2023, which would make Peter Schiff very happy if we were to get there. But we're really looking at this sideways pattern here on the weekly, and I've been talking about this stability that's being forecasted across the board. Look at all the moving averages. They're basically all locked in at 1948. So that's going to around 1915, 1960 down to 1920. That's probably where we're just locked in here. And whether we can get out of these ranges or not, it's going to be hard to say. I think we just get locked in. I don't think these fib targets matter up or down at the moment. The indicators are suggesting stability as well. The only thing that is a little bit negative is that the PPM3, which is tracking that 40-week moving average is rolling out, but it's really just losing momentum. And it's, even if I look at some of the forecasts going out here, it's still positive even though momentum is dropping. So there's still a slight upward slope on all of these patterns here. So sideways is probably the answer. And gold, other than, you're really looking at a range of around 1900 to 2000, 2010. That's really where we've been oscillating, and it looks like that's going to be the continuing story as we go forward. Go to Bitcoin. This will be the final market. So Bitcoin, as I've been talking about, right along this 40-period moving average is really the upward slope that looks really still is the only positive thing here, although somewhere in the next week or so it's going to start to flatten out. But it's very similar to gold. It's just getting locked into these moving average patterns that are suggesting around 27.8. I'm rounding numbers off with the low of that 25,500 number. We printed down to 24,920, but right around 25,500, 28,000 is going to be the top end of this. Algos are suggesting some positive on ppm 1, which all it tells us that we're going to challenge that value, which is 27.8. I'm not likely to get much above that level. The 200-period moving average is in here, and that's right now at 27,770. So really, if I had to make a call here, I think we stay locked somewhere between 25.5 and 27.7, maybe 28,000. Okay, folks, that's going to do it for tonight. I appreciate everybody. We got out of here right at 1 hour, which is the typical show I go for. I think there's some challenges that could happen this week, but more all just range-bound markets is what it looks like to me. I don't think there's any major move up or down coming, and I think it'd just be volatility around some of this Fed talk. Like I said, I think about anything you can come up with on the Fed is already priced in. Whether they do something or they don't do something, I'm not sure it even matters. But I think maybe Powell's speech will generate more volatility than what action they take or don't take. And, for me, I'm hoping that they do at least one more raise in rates, and I think that will convince a lot of folks. That'll keep their credibility, because they're more worried about credibility than blowing up the market. They're not worried about blowing up employment, because you can see the numbers just stay rock steady on employment numbers. There's just a lot going on that's really gives them the leeway to do whatever they want. And inflation, as I hope I pointed out, is long from over. Anyway, folks, like I said, just remember there's a possibility I could be about a half hour late tomorrow. I don't expect that will be the case, but that we should have a fairly normal week as we go through the week as far as the nightly broadcast at 6 p.m. So thanks again for watching. I'm just taking a quick look at some of your comments. Appreciate it. We need to do a show where I just interact with you folks, and maybe possibly Wednesday that could happen during the day if I can do a live stream. Just there's a couple things pending that I'm not sure about at the moment. So thanks for watching. We'll talk to you tomorrow night, same time, 6 p.m. Could be late, but I think I'll be on time. Thanks again. See you.